All right, welcome to the explainer. So, you've sold an asset, and the profit you've made can be taxed in two very different ways, either as a capital gain or as business income. And, getting this wrong can cost you a lot. The line between them isn't always clear, so let's dive in and figure out how to tell the difference. Well, if you ask the Canada Revenue Agency, or the CRA, they'll tell you it all comes down to one simple question. What was your original intention when you bought the asset? Now, that sounds pretty straightforward, right? But as we're about to see, proving what was going through your head when you bought something, that's a whole other story. So, what happens when your intention isn't quite so simple? I mean, what if you had a plan B? Or what if your original goal just completely changed over time? Yeah, this is where it gets tricky. And this is exactly when the CRA starts to look really closely. Okay, so what exactly does the CRA mean when they use the word intention? Well, in their world, it's all about your primary purpose. Think of it this way. Were you buying something for the long haul, maybe to get some rental income? That's probably a capital asset. But was the plan all along to flip it for a quick profit? Well, now you're talking about something that looks a lot more like business inventory. And this really gets to the core of the issue. Trying to prove what you were thinking years ago, that's tough. It's even harder if you had a secondary or a backup plan. Because if you tell the CRA, oh yeah, my fallback plan was always to sell it for a profit, you better believe they're going to want to see some proof that was on your mind right from day one. All right, let's look at a really common example of where this all plays out. Property that changes its purpose over time. This is where that whole intention question really comes to life. So picture this. You buy some farmland, right? The plan is to, farm it, generate some revenue. But then years down the road, you decide, hey, I'm going to develop this into a subdivision and sell off the lots. The second you make that decision, the purpose of that land changes. It goes from being a capital asset to business inventory. But here's a super important point. Just changing your mind, that itself isn't a taxable event. You don't owe any tax at that specific moment. So, how does the profit get handled when you finally do sell the property? Well, the CRA actually has a really clear policy for this. They basically draw a line in the sand on the exact day your intention changed. Any increase in value before that day, that's your capital gain. Any profit you make after that day, that's business income. And you report both of them when the property is finally sold. And this brings us to probably the single most important thing you can do in this situation. If you want to lock in that more tax-friendly capital gains treatment for all the appreciation up to that point, you have to get a formal appraisal done on the very day the property's use changes. That piece of paper, that's your proof. It establishes the fair market value at that absolutely critical moment. Okay, so we've talked about property. Now let's switch gears to another pretty tricky area, financial securities. Because with things like stocks and bonds, this whole idea of having just one intention, it gets even more complicated. You see, unlike a piece of farmland, you almost always buy securities with two things in mind, right? You're hoping for some annual returns, dividends or interest, but you're also hoping to make a profit when you eventually sell. So, boom, right from day one, you've got a dual intention. So to deal with this gray area, the Income Tax Act gives you this really unique choice, but it's only for your Canadian securities. You can file what's called a T123 election. And what that does is it locks in capital gains treatment for all your future sales of Canadian securities. Period. The big pro here is certainty. You know exactly how it's going to be treated. The huge con, this decision is permanent. It's irreversible. Now, if you don't file it, you keep some flexibility. Maybe you can argue some trading losses are business losses, but you're always going to be living with that uncertainty, having to prove your intention to the CRA if they come asking. Okay, finally, let's talk about a brand new rule that pretty much takes all the guesswork out of one very specific area, flipping residential properties. Yeah, the government has decided to draw a very clear line in the sand on this one. So, as of 2023, we've got a new rule on the books for flipping residential property. It's what's called a deeming rule. And that's a big deal because it means it completely bypasses that whole question of your intention. Basically, if you meet certain conditions, the government just automatically deems your profit to be business income. And that means it's fully taxable. So what's the magic number here? It's 12 months. If you sell a residential property that you've owned for less than 1 year, that profit is automatically business income. End of story. The whole debate about what your intention was, it's over. Now, the law does recognize that, sometimes life just happens and it forces you to sell. So there are some very specific exemptions to this 12-month rule, but they're for major life events. So if you have to sell because of something like a death in the family, the birth of a child, or a marriage breakdown, this automatic rule doesn't apply to you. So what happens if you hold the property for more than a year? Or if one of those life events happens and the exemption applies? Well, you land right back at square one. It goes back to being a question of fact, and the burden of proof is right back on your shoulders to prove what your original intention was. Okay, so we've covered a lot of ground here, right? We've gone from these kind of vague intentions to some pretty black and white rules. So, what are the key takeaways from all of this? Let's break it down real simple. First off, for property, if the purpose of your property changes, say from a long-term hold to a quick flip, get it professionally appraised the moment that change happens. Seriously, that appraisal document could save you a ton of money in taxes. Second, for your Canadian stocks and bonds, you've got a huge strategic decision to make. Filing that T1223 election gives you absolute certainty that your gains will be treated as capital gains forever. But, and this is a big but, you lose all flexibility. It is a one-way street. So you really have to think about your investment style and choose wisely. And third, the new house flipping rule. That 12-month calendar, it is everything. If you sell a residential property in under a year, just assume that profit is going to be fully taxed as business income. That is, unless you can clearly show it was because of one of those specific life events we talked about. So here's the final thought. At the end of the day, in the world of taxes, having a vague intention can be a very, very expensive mistake. Your best defense, your most powerful tool is a clear, well-documented plan. So take a look at your assets and ask yourself that one question. Is my intention crystal clear? Because if it's not clear to you, you can bet it's not going to be clear to the CRA.